It's quiet out there, heading into the Lunar New Year. Quiet in the factories, quiet in the ports, quiet in the inboxes of many freight forwarders around the world. It's quiet in some ways, but far from it in others. This is this week's Freight Market Update. Today is January 27th. I'm Mike Emiliani, and let's get right into it. Global trade orders split into two distinct paths: deep bilateral integration among non-US powers and aggressive tariff ultimatum tactics from Washington this past week. The signing of the EU-India Free Trade Agreement represented a landmark achievement in the de-risking of Europe, effectively creating a massive economic counterweight to both Chinese and American protectionism. However, this progress was overshadowed by the US's threat of a 100% tariff on Canadian goods, a move that fundamentally challenged the stability of the North American trading bloc. As gold prices surpassed $5,000 per ounce and the WTO struggled to find a unified voice at Davos, the week concluded with global markets bracing for a year defined by extreme policy volatility and breakdown of traditional regional alliances. Shifting now to this week's ocean, air, and freight markets, beginning first with the US-China West Coast market. The Transpacific shipping corridor continues to see significant downward trend in rates as the market approaches the Lunar Chinese New Year. Current spot pricing has retreated to levels not seen since late last year, signaling a near total erosion of earlier rate hikes. On the West Coast, rates have dropped further than anticipated, currently sitting between $1,600 and $1,650 per container. This represents a significant decline in places pricing at levels reminiscent of November 2025. To the East Coast, rates for the East Coast have followed a similar trajectory, falling to approximately $2,400 per container. Carriers are now operating on thin margins, with pricing approaching the break-even point where space is being sold at nearly at cost. Now getting into the why. Why did rates check out the way that they did this past week? There's a few reasons to consider, the first of which, unexpected rate erosion. As mentioned before, despite previous expectations that rates would hold steady until the end of February, they've continued to drop instead as carriers struggle to secure volume, being operational at cost. Carriers are barely maintaining profitability at the current rate levels, with some likely selling space at cost just to fill vessels before the holiday shutdown. There's also volume exhaustion to consider. The pre-holiday rush is largely concluded, leaving only minimal shipments, as described as breadcrumbs, remaining in the system. And lastly, there's market sentiment. Importers appear to have front-loaded or paused shipments in response to earlier geopolitical and tariff uncertainties, leading to a premature softening of demand. Now looking ahead for importers in the weeks ahead, what can importers expect? Well, the immediate outlook suggests a market that's essentially done for pre-Chinese New Year. While rates may have stayed at these low levels or see minor adjustment for the remainder of this week or the next, a complete standstill is expected by the end of next week as factories in China close. Predictions for February indicate a dormant period with virtually nothing left to move as the holiday takes effect. Shippers can expect a quiet month followed by a potential post-holiday reset in March, though any recovery will depend heavily on the evolution of U.S. consumer demand and the clarification of tariff policies. Looking now at the air freight markets. The air freight market has continued its peak volatility phase as the industry nears the Chinese New Year. The air freight market has entered its peak volatility phase as the industry nears the Chinese New Year shutdown. Rates have seen a sharp week-over-week increase as capacity tightens and shippers scramble to clear inventory before factory closures. Looking first to the West Coast. Rates for the West Coast destinations like LAX have surged significantly from the previous week's lows. In week 3, high-density cargo was priced as low as $2 per kilo, but week 4 data has shown that these rates have jumped a little bit higher, all the way from $3.50 to $5.50 per kilo. This represents a week-over-week increase of about $1.30 to $1.50 per kilo for shipment standards. On the East Coast, rates to the East Coast, including JFK, have also climbed steadily. After hovering around $4.50 to the low low $5 mark in week 3, prices have now pushed around the $5 to almost $5.50 per kilo range. This reflects a more moderate but consistent increase of roughly 50 to 60 cents per kilo compared to the prior week. Now getting into the why. Why did rates change this week for the air freight market? Like the ocean freight market, there's a few things to consider. The first is that this is the final pre-Chinese New Year rush. With Chinese New Year holidays imminent, factories are pushing all remaining inventory out of their warehouse to avoid holding stock during the month-long shutdown. There's also space compression by the big fish and large shippers. Large enterprise entities like Tesla and major e-commerce players took up a massive amount of available aircraft space early in the month. This left the smaller to medium-sized assortment of shippers fighting for the remaining high-cost spot capacity in the final weeks. Manufacturer prioritization is another aspect to consider. Chinese manufacturers are prioritizing their largest clients, again, like Tesla, to ensure high-volume orders are being fulfilled and shipped before the holiday, even at the expense of smaller shippers' timelines. Like weeks past, and probably like for the foreseeable future, there's also tariff cautions. Recent threats of a 50% tariff on goods entering the US have created a sense of urgency for some importers to land their products before any potential policy shifts may occur. And then lastly, and as we'll kind of continue to see, I suppose, for the weeks ahead, lack of organic US demand. While rates are climbing due to seasonal capacity constraints, they remain historically below sky-high levels, because overall US consumer demand is still relatively weak. Now, looking ahead for the air freight market. The high rate environment is expected to persist until the formal start of the holiday period around February 2nd, which aligns with the current validity for many airline quotes. Space will likely remain at a premium through the second week of February as the final backlogs are cleared out. Once factories close, the market is predicted to enter a dead period for about 2 to 3 weeks where bookings actively will be non-existent. The long-term outlook for March suggests the potential for rate reductions if volume does not rebound significantly after the holiday. Shippers should be prepared for a quiet Q1 as the market settles and geopolitical uncertainties regarding new tariffs become clearer. As always, in the description of this week's update, you can find an assortment of links that we liked reading this week and that really helped go into this week's freight market update. As always, this week's market update was brought to you by Freightright's True Freight Index. If you're looking for an answer to the question, how much is it going to cost to ship today? Look no further than our True Freight Index. And that's all for this week's freight update. We'll see you next week.